Hello and welcome to another episode of Bidishanomics. I am Sabika Syed and with us Dr. Bidisha Bhattacharya, our consulting editor for economics, who takes your questions, dear members, on economy, India's position, what's happening in the global affairs and how it impacts our economy and the global economy. So, Bidisha, the first question is by Lakshmi Narayan. They're congratulating you on a brilliant article on long-term capital gains taxation and thanking you for connecting it to the global purchase behavior and always using like data in your story. And I know Bidisha always makes sure that she's solidifying her story and making it watertight with data. Their question is, what is the government's logic on increasing the tax? Did the finance minister even attempt to explain the legislation for LTCG tax increase?
Firstly, thank you for taking out the time to go through the charts and the analysis. And of course, this is a very pertinent question at this point in time, but also an uncomfortable one that needs to be addressed. So first, I'll talk about what are the justifications or the reasons that the government is given as to what or the 2 decades of tax changes that they have done. So the government's stated argument rests on primarily three pillars. Number one is equity across asset classes. So basically, the government's argument here or the rationale here is, why is somebody earning money from the stock market pay less tax compared to a salaried professional who's also earning the same amount of money? So if a salaried professional is paying 30% tax, then a stock trader should also be paying not 10% but 30%, basically creating a level playing field. Second pillar is revenue generation. Now, India needs money. We are an emerging economy, we are a growing economy. India needs money for infrastructure push, for roads, for highways, for hospitals, for welfare, etc. And capital gains is a very interesting area or a lucrative area for the government to actually raise revenue without directly touching salaries or consumption for that matter. Then comes the third pillar, which is reducing speculation. Now, this is somewhere where the finance minister was very upfront regarding in this year's budget speech when the announcement on the securities transactions tax was done, where she said that speculative measures need to be taken and to reduce, sort of basically make sure that the stock market is not being treated like a casino. So, in terms of short term gains, they have to pay higher taxes. Traders have to pay higher taxes, and making sure that any kind of fraud, any kind of incorrect money circulation is not taking place, and that is of course beneficial for the government as well. In one way, they would be raising revenue; in another way, they will be reducing the number of frauds. So here, each of these three pillars are not really. I would say that each of them have a proper rationale to it. They are defensible that way. But now here comes something very interesting, or an economic concept which I've mentioned in my piece as well, which is the tax elasticity of savings. Now, this is a concept in public finance predominantly, which basically says that if in an economy, if the government makes any change in the tax on savings or investments, how do people react accordingly? Now, what happens is, usually in case of US or say Europe for that matter, every time the tax has increased on savings or investments, the elasticity is not very high. It's less, it's low, specifically because their pension funds are also in equities and they don't really have other options to move to immediately. People still keep investing. Now comes, in case of India, this elasticity on savings is very high. Because people immediately, when they see that there is a level playing field, or they are having to pay the same amount of tax that they would have sort of paid in investing in a fixed deposit for that matter, or in any other asset for that matter, they immediately quietly move away towards physical assets. Say for instance, gold, real estate, fixed deposits, as well as land. So this is an area where the government ends up, of course, not earning the right kind of revenue or higher revenue by imposing these kind of restrictions. And at the same time, there's a huge section of the population that completely moves towards sort of owning physical assets rather than investing in financial assets or financial savings for that matter. And there is evidence for it. So as per the latest data, I would like to specifically say, how much the data shows, or what do the numbers specifically say. So number one, the gross household savings, and this is, by the way, the data directly from the RBI Handbook of Statistics. The gross household financial savings have dropped from 11% in 2021 to 5.3% in 2024.
Right.
That's not only half, but it's a little more than half. Then comes another number two, where 71.5%, today as we speak, 71.5% of India's household savings is actually in physical assets like gold, like real estate, like land, and 28.5 is in financial savings. Even out of that, barely 8.4% is in mutual funds. Now, even if we look at the ratio or the percentage of mutual funds as a percentage of GDP in this economy, right now it's 19%. In the US, it's 140%.
Okay.
So now you might say, why are you comparing with an economy like US? Let's take Brazil for that matter. Even in Brazil, it's 68%. So every single percentage point of this gap is actually the amount of money that is lost into the money that could actually have gone into deepening bond markets, into financing Indian companies, into addressing domestic investment and domestic savings, and kind of inculcating and strengthening that. So which is why it's a very, very imperative area, and an important topic to discuss. Then comes, of course, the ratchet, exactly what has happened since 2004. In 2004, there weren't as such, so many taxes imposed or so many changes that might have taken place. And after 2004, specifically in 2004, the securities transactions tax was introduced. And after 14 years of exemption, the long term capital gains tax returned as well. Then the Finance Act of 2023, which removed indexation. So, what was happening, or what is happening right now, that you're not being taxed on the real gains, you're also being taxed on the inflation that took place.
Right.
That makes no sense. So, here, did the finance minister explain it? Now, the finance minister, to an extent, has explained it. Largely on grounds of simplification, as I have earlier stated, because and she is right in saying that the tax structure or the tax procedure needs to be as simple as possible, because that encourages compliance, that encourages people participating more, paying taxes on time and getting into the formalization structure for that matter. But I think it's high time to not only, whenever these kind of taxes are imposed, or indexation or something, these kind of policies where indexation gets removed, we should not only look at how much, or the government must not only look at how much revenue it can earn, but high time they look from a more dynamic perspective.
Right.
They look at the trade-offs as to how would it cost investor confidence. It is very important, because that is where we are seeing, if the gross household savings, financial savings, has dropped in 3 to 4 years from 11% to 5.3%. And especially in today's day and age in India, where domestic economic profile has to be very strong, because otherwise we'll be always vulnerable to a dollar change, for that matter, any external shock, for that matter, any global disruption, being an import dependent economy. So this, I believe, that needs to be strengthened and needs to be addressed. And this is a very opportune moment, I would say, for the next budget, where probably the indexation can be brought back. That is high time. I mean, these measures or the solutions that I've given, even in my opinion column as well, are none that require huge changes or completely reforming an entire structure, for that matter. It's just bringing the indexation back, so that people understand that they are only being taxed on their real gains and not the inflation that has increased, because inflation will increase now, given we are seeing increase in fuel prices right now, and there'll be stages of increase in the food price. Fuel prices are increasing, there'll be food inflation, keeps increasing, decreasing, there's a fluctuation that keeps happening there. And of course, also, in terms of debt mutual funds, I forgot mentioning this, debt mutual funds as well, after the Finance Act of 2023, there was a tax equivalent to to fixed deposits. So a lot of these middle class savers who were investing in the debt mutual funds, they quietly moved away and started having fixed deposits or investing in gold and other physical assets. So they can be brought back into the mutual fund system, and then the ratio can be increased, and then we can directly sort of invest into Indian companies and deepen our bond markets and financial markets even further.
Right. Now, Vidisha, lots has been happening in geopolitics. Of course, Iran is trying to have a deal with US.
Yeah.
Marco Rubio is in India right now, and they're talking about trade and energy. And so the next question is by Saito. They're bringing in oil, and funnily enough, I recently ran into a tweet where it was a tweet by this anonymous account saying, "Oh look, oil is the new oil." So they're asking, once oil isn't important anymore, once we have all shifted to solar, SMRs, or EVs, will everyone continue to keep huge dollar reserves? China is currently the manufacturing powerhouse. What if India developed her manufacturing sector better by then? Could we ever see an INR reserve everywhere, or are there some other criteria for a global currency as well, apart from stability and important goods being exported in the said currency?
This would be one of my favorite kinds of questions, because this kind of pushes us to think about the future of money in general. How would it look like in the future? And you have the viewer has very correctly packed in three big ideas into the question, and I will try to unpack them one by one. First, it's important to, before understanding that whether dollar, now that oil reserves and oil in the future might not be as important, will the dollar dominance reduce? So first, it's important to understand, why do countries hold dollar reserves at all in the first place? Why does it exist in the first place? Now, the short answer to it, everybody gives, is oil. Because oil, this is a petrodollar story. Since the 1970s, oil has been imported or traded completely in dollars. Now, if you are in Japan or in South Korea or in any other country for that matter, and you had to purchase oil, you had to purchase it, you still do purchase it in dollars. Here comes a very important logic. That means, it's kind of a self-reinforcing mechanism, which is something that I will get into a little later in the foreign exchange reserves. But the self-reinforcing bit is that, for trade, you need to hold a good amount of reserves in dollars. If you're holding a good amount of reserves in dollars, then the financial markets are regulated and circulated in dollars. And because those financial transactions or markets are being sort of regulated in dollars, as a result, you need to hold more dollars as a country. So it's kind of a loop, and breaking that loop is not something that only oil can do. Now, there are other facets to this story as well. To be specific, 57% of the global foreign exchange reserves or forex reserves are denominated in dollars. Now, this has come down from 71%, which was at its peak in 2000s, and now it has sort of come down, but gradually. Of course, it has taken a good amount of time, but even now we have an overwhelmingly strong, deep financial market, or the US Treasury market. And here, before I get into the US Treasury market, I would like to talk about one concept which we have discussed in the previous two episodes as well, which is network effects. So for instance, think about, let's say, the telephone. So if more people are using telephone, then the demand for it increases, because the other section of the population who are probably not using it, even they'll need to purchase it, because all communication and business communications, or even personal communications for that matter, are happening in the telephone network. This is very similar to how the dollar functions in general in global networks. What do I mean by that? It's not really about how much of dollar is being circulated in the economy, but it's because how many countries are utilizing it, and on a daily basis, for every single transaction for that matter. That flow matters here a lot, and this is a big cycle. So reserve currencies work in a very similar fashion. So here, it's not about the dollar is seen as one particular currency that is dominating an entire picture, but it's also because every other country is using it, and the ones that don't, they are compelled to use it because the transactions are happening in dollars. Coming to now, what actually exactly makes a reserve currency? There are multiple criteria for it. The first one being the economic size. So you have to be a very large economy and a trusted economy. For the past 80 years, US has been providing that credibility and that institutional credibility, which is where economic size plays an important role. Second is deep liquid financial markets. I've just spoken about the US Treasury bond market. It has provided so much of credibility and trust, and of course, the legal framework and the contractual framework as well, which is where every time there is a disruption, there is an external shock from, especially from emerging economies, even other countries as well, investors immediately withdraw their funds and park it in the US Treasury funds or US Treasury bond markets. Then comes capital account convertibility. Now this is where it gets a bit interesting, especially for India. Now in India, on a very different context, from a historical context, we did discuss this previously, but in India, capital is completely convertible in case of current account, which is trade in goods and services, but it is partially convertible in terms of capital account, because we are a growing economy, and in terms of making investment decisions and making sure that most of the money or investments are in this country, to be specific, we need to be partially convertible. We are not fully convertible in capital account. US is. So if you have to be a reserve currency in the future, or even now for that matter, you cannot say that, hey, you keep my currency, but you cannot move it freely. US can say that, but we can't at this point in time. And now comes a very interesting bit about oil that was mentioned in the question, that if oil becomes irrelevant, will the dollar dominance reduce? To an extent it can, but it will be just, out of, if I say 4 or 5 pillars that I spoke about, that will be just one pillar that could weaken, but the network effects remain strong. The global financial markets will still use dollars, will still be, the transactions will be denominated in dollars. So it will definitely, now when it comes to EVs or solars or energy dependence for that matter, it will, this energy transition, I feel, that will open a certain window which was not opening for a while, which is creating an economy or a world economy where the dollar might not lose its dominance, but there will be a multi-currency framework in place. There'll be others, a little stronger currencies. Let's say, for instance, the Japanese yen or renminbi or the euro as well, different other currencies which will also gain some strong ground and solid ground. And there can be some, they can trade in their own currencies, but I don't see a complete removal, of a currency that has built that amount of institutional credibility for the past 80 years. And then comes a very important, before I go to the historical reason, there was a specific part of the question which spoke about China and India.
Right.
Now, China holds approximately, or the renminbi holds approximately 2% or 2.2% in the global forex reserves. Now, there's a reason for it. Being the second largest economy, why is there only 2% of it in the global reserves? The reason is China has been very, very strict about having capital controls or institutional and legal controls. China doesn't allow its capital to flow freely in and out of the system. So this is where, and that is completely very intentional. It is planned, as a result of which, of course, the currency, if capital is not allowed to flow freely, the currency is not allowed to flow freely in and out of the system. And they have not exactly a fixed exchange rate, but there's something somewhere between a fixed exchange rate system and a floating exchange rate system. So which is where China, I don't see, in the future that China can replace US dollar as a reserve currency. Then comes, of course, talking about India. For India, there of course is a possibility and discussions around, and especially the RBI in 2024 had also created 156 special rupee Vostro accounts
Okay.
in 30 countries or so, where they could hold now rupees currency and they could trade in those currencies. And even UPI in general is now across 7 countries, if I'm not wrong, with UAE, France, etc., many other countries as well. So the RBI, the central bank, has been doing its bit into sort of increasing the trade in our particular currency so that we can be shielded or we are less vulnerable from the external shocks. But in order to reach that position of reserve currency, of course, one that I spoke about, that we have partial capital account convertibility, and I don't know if in the near future the RBI or the government plans to make it fully convertible. And second would be specifically that deepening the financial markets or bond markets. That is exactly what we discussed in the previous
Right.
answer. So it is high time. Our bond markets are strong, but they are not as strong as to qualify rupee to be a reserve currency for that matter. That's extremely important. And of course, the final reason that I was talking about is the historical or the lag that it takes, for a currency to become a reserve currency in general, because there's a big difference between reserve and managed currency. If you say that a currency would be a reserve currency, then you'll have to allow full capital account convertibility, complete movement of the currency in every economy possible. There has to be a contractual framework in place. Now, for a reserve currency to be there for 2 centuries almost, the pound was actually the strongest or the reserve currency until the US dollar took over. And even after that, it has taken a good amount of years for it to emerge as the dominant currency. So it takes a lot of time for a currency to emerge as a reserve currency. So that would be my response.
Right. Now we're talking about global markets and trust and credibility and reliability. Sankalp has a question on this. They're asking, are austerity measures a poor signaling to the markets? With so many global disruptions parallelly, Trump, Russia, Ukraine, Middle East, and AI, was the best India can hope for when even the World Bank has lowered global growth projection?
So this word is being thrown around left, right, and center, austerity. So first, let's understand, what does austerity mean, to be specific. Austerity simply means that the government decides to cut its spending or raise taxes in order to reduce, the target is very specific here, in order to reduce or narrow down its fiscal deficit. That is the target of any austerity measure in the first place. So now that we've understood, okay, what is austerity? So is austerity a bad signal for markets? Now it completely depends on when you do it and how you do it. And here comes an important concept. I've spoken about this in a previous opinion column of mine, as to Mr. Modi's 3 asks.
Right.
So here the concept is fiscal multiplier. So basically, with one rupee injected into the economy, does it generate more than 1 rupee of economic activity or less than 1 rupee of economic activity? Now, when the fiscal multiplier is greater than 1, then it is generating more than 1 rupee of economic activity. When it is less than 1, as simple as that, then you should leave it to the private sector. Basically, the private sector can generate more than 1 rupee of economic activity. That's the signal. So now, historically, or the research that has taken place so far, it has been seen, the critical aspect here is fiscal multipliers are more damaging or much larger in case of downturns than in case of booms. What do I mean by that? If an economy is already going through a difficult patch where, say, unemployment is very high, inflation is also very volatile, it's a difficult economy, the deficit is widening. In that particular situation, if government cuts down its spending, the damage is detrimental.
Okay.
And the fiscal multiplier is large. The multiplied effect adverse effect or beneficial effect. Both of them are large in that particular situation. However, if an economy is doing well, which is where I mean sort of jobs are generating, or there is infrastructure push that is taking place for that matter, this is the time, if government cuts down its spending a little bit, that can actually have a beneficial impact and help in narrowing down the fiscal deficit. Which is why I mentioned the definition in the first place, because it's important to understand what is the government trying to target at this point in time. Now coming to the specific part of this question as to where is India on this road. Before we get to it, have there been austerity measures that have taken place in the past, and have they been successful? In Europe in 2010, it was done. In Greece, Spain as well, there have been periods when austerity measures were taken. However, they did not boost or restore confidence. In fact, they resulted in a higher debt to GDP ratio, and the deficit worsened. So now, where is India in this entire picture, and is it, or does it sound like an European kind of a situation? Firstly, India is, or what the government is calling it, is a fiscal glide path. Basically, they are trying to narrow down the deficit situation given the widening current account deficit that we already have. So here, I would just like to mention a couple of numbers. The fiscal deficit was 9%, had gone up till 9% during the pandemic years. Then it reduced to 4.8%, and now 4.4%. And as per the budget speech, the 2027 target is 4.3%. Now, in order to reduce it to 4.3%, and also it is important to mention that the debt to GDP ratio target by 2031 is 50% of GDP. Right now, we are standing at 56%. Now, it's high time, especially for an economy like India. It's important to understand European economies, these are more export dependent economies. We are a more import dependent economy, and also our growth primarily happens from domestic consumption, domestic investments. So, which is where it's extremely important that the debt to GDP ratio is controlled, the fiscal deficit is in a particular range. Which is where, now coming to sort of the question is, can we also expect, or should we fear of that kind of a situation in what happened in 2010 in Europe? Not really, because the government is being very tactful. It is not cutting down on infrastructure spending. Notice this, that it is trying to cut down on spending or expenditure where the ministries cannot really absorb that money. So it can be certain physical asset, it can be, gold, as it was said that don't buy more gold, don't go for foreign trips, etc. So this is something, it's important to understand, that the infrastructure push has actually increased. In fact, there's a good amount of money that is being moved from other sectors towards increasing, building roads, building highways, because that boosts business activity, that boosts manufacturing activity, which is our target for that matter. Of course, I don't know if we ever will be able to become a global manufacturing hub like China, but the target is, of course, to increase our manufacturing sector activity, because that is where that generates unemployment, that reduces unemployment, generates more jobs, helps us climb the growth ladder faster, and also keeps the inflation in control. Here, also, there's a part of the question where it's spoken about the global storm, the storms that India is facing right now. There are a couple of them, and I would like to mention each and every. First, of course, we all know Trump and tariffs. Here, should we worry as much as, people are? I don't think so, because right now most of our exports to US is around services, which is IT, business related services. These are the areas where the tariff impact is not as bad as it is in goods. When it comes to the export of goods as well, we are not as integrated as China is. So of course there is a certain amount of loss that we would be experiencing, but not not something to worry as much as probably it would impact any other economy that is way more integrated in export of goods to US. Then comes the second, which is Russia and Ukraine. India, I believe, has done an impeccable job here in diversifying its oil imports, and it has continued to, despite the war and geopolitical situation, it has continued to import oil from Russia, as a result of which we did not experience the huge jump or spike in oil prices or fuel prices as much as we would have if we would have been completely dependent on the Middle East. Then comes, of course, the Middle East conflict. This is something which is hurting India the most at this point in time, and something that is highly responsible for our fuel prices increase as well. And given the data forecast, I see the fuel prices going up even further in the near future. Then comes AI and technological disruption. Now, this is something that is not being spoken much about. Definitely, will AI and technological disruption hurt our trade? To an extent, yes, it will, because in the services area, there are certain things that we are doing. Specifically, there are certain jobs in the services sector that India does for the global market, which can be easily done by AI.
Yeah.
So that can be replaced, that market can get replaced, and that might have an impact on our GDP and our deficit as well. But at the same time, this is also giving us an opportunity into building a domestic data centers, technological kind of a powerhouse from a domestic perspective, so that we don't have to be dependent on these areas. And we can actually see, given the China plus one strategy, we can actually see a lot of diversification happening. Apple, Samsung, for that matter, they are moving their manufacturing or sort of intermediate production towards India. And there are multiple other organizations and other companies as well who are planning to do so. So what is the best that India can hope for at this point in time? I believe that India has a lot of advantages at this point in time, especially talking about the young population, and also given the fact that what are we export dependent on with the US. Yes, definitely we've experienced a premature deindustrialization where our manufacturing sector might not have developed as well as China's did, but in some way it is working as a boon. So here, of course, the domestic demand bit, as I stated, we require the right kind of skilling. We have the young population. We have a very growing, strong middle class. So from the investment perspective, that is something that is the fiscal policy area that the government needs to look into and change, as we've spoken about the tax structure in the first question itself. So as I had stated, and I've been stating it multiple times in the recent last 3 months or since February when the war began, and I'll repeat this again, that RBI has done its bit. It's time for the government to act now. Monetary policy has been doing its bit for a while. Now the fiscal policy has to enter into the picture and make certain changes. So high time, because even from the China plus one strategy that we spoke about, this is entirely where fiscal policy has to make changes. The RBI has done its bit with the interest rates, with inflation targeting, and it is continuing to. But yeah, this would be the area, and also we have the strong demographic dividend, which can make full use of this potential, especially where AI and technological ecosystem is concerned.
Yeah. Bidisha, the next question is by Andle. They're referencing an article they've read by the TOI about Firoz Aziz, joint CEO at Anand Rathi. Now, Anand Rathi has proposed that citizens consider monetizing 2 to 4% of their idle gold, potentially adding a portion of $4 trillion worth of gold into circulation and thereby reducing the nation's annual import burden. Now, Andle is asking that they would like to understand if this is really a workable idea overall. If yes, how can the Modi Sarkar encourage such sentiments among masses? Is any one-time scheme, for example, the Swarna Udgaman Abhiyan, in the offing with no questions asked, 100% tax breaks for families bringing idle legacy gold into circulation?
Now, I love the name that has been coined, Swarna Udgaman Abhiyan. That's genuinely an interesting name. I feel that it's important to break this question down into two parts. The first is, before we get into what government should do, first it's important to understand the scale of this opportunity. As very rightly stated, Indian households hold, and by households I don't only mean households, I mean temples, trusts, they hold gold somewhere between 25,000 to 34,000 tons of gold.
Okay.
Now, Morgan Stanley, there have been multiple reports around, but Morgan Stanley has also reported around 31,640 tons of gold. And specifically, this can generate, I mean, the article that he's referring to had said around 4 trillion, and to be specific, Morgan Stanley had said around 3.8 trillion.
Okay.
That could be that was the value. Now, that is roughly, if we go by 3.8 trillion, that is roughly 89% of India's entire GDP. Now, to value that in perspective, it's important to understand that the amount of gold that Indian households are holding, or these temples and trusts and all of them are holding, is greater than what the top 10 central banks in the world are holding.
Okay.
So, here comes also an important factor, because India has recently, or India on a yearly basis, imports 750 to 800 tons of gold, and that is widening the current account deficit to a great extent. So the logic is here that if there could be a proper scheme which could pay a solid amount of interest, and attract, or come across as a scheme that would be lucrative for Indian households to deposit, even if it is between 500 to 1400 tons of gold for that matter, that could actually take care of these imports and reduce the import bill to a great extent, and that would help promote the consumption, the domestic demand, the growth, the investment in the economy. Now, here comes an important concept that I would like to here talk about and mention, is called dead capital.
Okay.
So this was actually introduced by a Peruvian economist, Hernando de Soto. So he has done some phenomenal work in the informal economy area. He had said that there are millions of poor people across countries who hold certain physical assets which cannot be transacted in monetary terms or financial terms. So their value, or their optimized value, can never be recognized, and that goes for a waste. In India, gold is kind of posing as that kind of an asset. For some countries it can become land, for some countries it can be any other physical asset for that matter. So the economic opportunity lies here on unlocking a fraction of this asset to be able to reduce the import bill, narrow down the current account deficit. Now comes an inconvenient truth. So, have we tried this before in India? Yes, we have. We have actually tried this 2 times. In 1999, there was a gold deposit scheme that was tried, and in 2015, very recently, we tried the gold monetization scheme, where 2 to 2.5% interest rate was offered, and people were said that please come and deposit certain amount of gold, and this is the amount of interest that will be offered to you. However, let's talk about the gold monetization scheme in 2015, that the government could actually, enable people, or rather incentivize people to deposit approximately 31 tons of gold. Now, even if I go by the number of 25,000 tons, 31 tons is nothing.
Yeah.
Then comes even the gold deposit scheme in 1999 as well. Even during that time, over 2 decades for that matter, they could only generate roughly 15 tons of gold. So now, what is going wrong? It's important to understand that there are a couple of reasons for it. The first reason being emotional attachment.
Right.
Now, in India specifically, gold has an emotional attachment where it is either inherited from your ancestors, from your grandparents, a mother giving her gold to her daughter during marriage. So this kind of emotional attachment has a very, very important, especially from a behavioral economics point of view, an important role, where people usually prefer not letting it go for a deposit or something that they are sort of worried that, this will be melted, this jewelry will be melted, and I might not get back the equivalent amount of money. So this is where emotional attachment comes into the picture. Reason two is the black money problem. So this is where basically most of the gold that is inherited, almost every family, there is a certain amount of gold that they have that they don't know about the source, or there is no documentation really available of that gold. Now, if you take that gold to any bank to deposit, they will be asking you these basic details, and people are not very comfortable with this kind of scrutiny. So this is something that is also making Indian citizens holding back from depositing gold. Then comes another reason, which is the interest rates that don't compete. Now, gold's valuation has increased by 30%.
Okay.
You are offering 2 to 2.5% interest rate. Why would I deposit gold with you? So this is something that the government needs to reform, and banks need to look into the matter, that at least 3.5 to 4% interest rate needs to be provided. Otherwise, it doesn't make sense. Why would people go ahead and deposit gold? Then comes the fourth, which is the infrastructure gap. Here, there was a particular scheme or a policy which focused on collection and purity testing, or building collection or purity testing centers, which has not been successfully done by the government. And that would require a good amount of cost. That would also require focusing on tier 2, tier 3 areas. These need to be built so that, in a seamless fashion, this process can take place, but that has not happened so far. Coming to that, would a Swarn Udgaman Abhiyan, how would it look like? It would look like simple procedures, transparency, increasing the interest rate, as I mentioned, 2 to 2.5% at that interest rate. Nobody would be incentivized enough to go and deposit their gold. Also, people are very sensitive about, as jewelry, I specifically mentioned that melting jewelry and using it for the Indian system or Indian companies for other. Gold is not only used for jewelry, it is also used for certain production processes. So that is where things can be kind of defined better. A cash equivalent amount can be given to those Indian companies, and the jewelry might not be melted, or people deposit in sort of gold biscuits, or things that they wouldn't mind, or they wouldn't have a certain amount of association as to this would get eroded, and they would not get the cash equivalent of it. And of course, the last mile access through Jan Dhan accounts, because we have now a huge, significant percentage in the economy of Jan Dhan accounts which are linked to Aadhaar. So, and also a strong digital infrastructure in place. So, if that could be connected with this gold monetization, I have a feeling that that could actually boost the increase in deposit. And as I stated earlier, that from 25,000 tons, if roughly even 500 to 1400 tons could be pushed into the banking system, nothing like it. It could actually help us reduce our vulnerability to external shocks and boost our domestic demand and investment.
Right. Now, Bidisha, Ranjit Pal is asking, could you give us the data of previous long year where Indian government increase of import duty by 30 to 50% has instead increased tax collection from gold, as all gold is not bought by jewelers or others illegally?
Um, Very interesting question. And here I am reminded of a Laffer curve concept.
Okay.
So this was actually introduced by an American economist, Arthur Laffer, and very famously, apparently in 1970s or 1974-5 around, he had sketched this curve in Washington in a restaurant in a napkin. So that's the story. Laffer curve, basically, where he said that if a tax imposed on any particular commodity is 0%, you earn zero tax revenue. If the tax imposed is 100%, you still earn zero tax revenue, because people find other ways of avoiding paying that tax. So there has to be a sweet spot somewhere. And the Laffer curve basically looks like this. If possible, we'll share it
Right, of
on the
course.
screen. So here, the idea was beautiful, and finding that sweet spot or that perfect tax rate where people are not evading or avoiding this taxable activity and finding other ways. For instance, in case of gold, the other way is smuggling activity. So now, going back to a timeline, specifically around 2004, 2005, or 2012. Let's talk about 2012 and 13 because the taper tantrum had happened around the same time. So before 2012, there weren't such import duties and all of that. Gold, on gold specifically, and as a result, smuggling activity was under control. Then came around 2012 and 2013, slowly and gradually, there was sort of a 400% increase, I would say, in the import duty. It started from 2%, moving to 4%, to 6%, to 8%, to ultimately in 2013, it was 10%.
Okay.
So that increased smuggling activity to an extent where it kind of became a business plan. And the Directorate of Revenue Intelligence as well was not being able to get hold of even 1% of the smuggling activity that was taking place around. So there, did it reduce imports? So now, coming to the question, did it actually increase tax collection? No, it did not, because people always find another way, as I had mentioned just a little while ago, that gold is not only used for jewelry here, gold is sometimes for certain production processes is used as an input. Now, if you have to pay import duty as high as 15%, companies or businesses found a way of actually not paying that duty, especially they were actually rerouting gold or sort of infusing platinum with it or rerouting gold via UAE so that that 15% could reduce to 5%. And this has happened multiple times, and it's very difficult for the government to catch hold of the quantity of gold that is being smuggled through or rerouted for that matter. So here, again in July 2024 around, there was a single cut that took place, and it immediately saw a drop in smuggling activity. But again, government increased it to around 15%.
Okay.
Now the question is, despite the World Gold Council has also given reports and shown data that every time you increase the import duty, smuggling activity increases.
Okay.
Despite that, government still does it. Government, knowing after knowing all this information, they still do it. Now the reason is why? Because gold or increasing gold import duty kind of gives a very interesting demand signal, or that the government is doing something about it.
Okay.
Let me get into the detail regarding this. Let's say, for instance, right now the situation that we have is a widening current account deficit. Our foreign exchange reserves have dropped from $728 billion to 692. Right now it's standing at $692 billion, which is why Dr. Geeta Gopinath has written about letting the rupee fall. And then, of course, Dr. Arvind Panagaria as well has spoken about, don't fret over the exchange rate dropping to 100 as well. So because the primary reason for this is because of the dwindling foreign exchange reserves, and that can get very risky as we are an import dependent economy and we transact in dollars. So here comes sort of, why does government still do it? Because government likes to send a signal, or any emerging economy for that matter likes to send a signal to the rest of the world or the rest of the other markets that we are doing something about it. And putting across a signal which is very quick, and it reaches to all the other markets that we are increasing the gold import duty, and as a result of which we are working on stabilizing the economy, and everything is in a good situation. We are boosting investment and we are raising revenue out of it. Now in the process, on paper it might show that you have reduced, let's say, or the revenue that you're collecting might be lower, but actually the smuggling activity increases, or the demand for gold, on paper the demand for gold might reduce, but all in all, gold as an asset is such that even if you put tax on it, its demand doesn't really dwindle. Because, be it for wedding purposes, be it for emotional attachment, be it for any other business reason or production reason, the demand for gold at least will stay intact, if it will not increase. So this is where then people find different ways, and of course government loses out on GST revenue, the organized jewelry sector gets hurt. But the reason as to why government still does it, despite these warnings, despite this happening in history as well, is to send a signal across to the rest of the world and the foreign exchange market, to be specific, that we are doing something about it.
Right. Now, Bidisha, for the last question of this episode, the question is by Surbhi. She's asking, Trump has proposed a gas tax holiday to fight the energy crisis. And if it actually goes through, won't the massive loss in tax revenue force the government to borrow more, causing bond yields to spike, ballooning national debt even faster? How much debt is too much before the system fractures?
Very interesting question. Now, first, it's important to understand that this gas tax is a federal tax. It is a tax on the supplier. Now, historically, what has taken place in the US, that every time this kind of tax has been imposed, it has not really passed on the consumers. So the percentage, usually the suppliers or the sort of petrol stations, they kind of reduce their cost, and that doesn't really get transferred. And in the process, at least there are two reports specifically that have spoken about it: the Bipartisan Policy Center and also Wharton budget model, the University of Pennsylvania's budget model. Both of them different procedures, but they have come down to the same number, which is $17 billion worth of loss or debt can be generated because of this gas tax holiday. Now, it's also important to understand, given the current Iran, US, Israel conflict, there has been an increase in inflation in the US economy, and it has very badly hit certain sectors of the economy. Hence, this gas holiday which has been proposed. But here it's important to understand that there is no political cover to this, because the trucking companies or the trucking sector, and also people associated with infrastructure or road, this is usually the population or the demography in US that is highly biased towards the Republicans.
Right.
They have also come in protest against this gas tax holiday, because even they are saying that this little sort of tax holiday will do nothing to our revenue, but overall it will create a huge loss in the fund. There is a particular fund where a more sort of, this will be a dent to the fund which takes care of infrastructure improvements, if roads go bad, highways, petrol stations, sort of taking care of certain sanitary measures as well. So this is a fund which is the Highway Trust Fund that is already debt ridden. They keep borrowing from the government, and in this particular situation, if there is a further dent of $17 billion as has been estimated, this will worsen the Highway Trust Fund even further. So now, coming to the debt situation, of course everybody knows that US right now has a debt of approximately 38.5 trillion. Now, this number is so large that it sounds almost meaningless at this point. And but America, and it's very interesting, I would like to mention some data points here, that America is adding $6.4 billion to its debt every single day. Not even week, not even month, every single day. And debt by itself has kind of become a crisis, and the government has been projecting that if it continues this way, a huge percentage, approximately roughly 84 to 85% of its budget by 2032 or 2048 for that matter, will go into debt servicing. The interest payment burden is huge. Now, how much debt is too much debt? There have been multiple estimations and projections that have been done. However, the debt doom loop needs to be mentioned here. Everybody has had their opinion about, okay, how much it can be. 140%. Right now for US, it's 101% of GDP, which is a huge number for that matter. And here I would like to talk about this debt doom loop concept, and it's very difficult to come out of this concept. However, in the past, Canada has done it, Germany has also done it. But specifically, what happens is, if you enter into this debt picture where you are borrowing money, now as you borrow money, you'll have to pay a certain amount of interest. Over time, as your lenders see that, given the external situation, disruptions and this and that happening, wars taking place, you probably instigating most of its wars, in this situation the lender also gets a little worried as to if they'll get the money back. So they say, fine, okay, fine, we'll lend you more money, but we'll now charge higher interest to it. Okay, so now say for instance, in this particular situation, US borrows more money. That's exactly what has happened with the US borrowed more money. Again, the circulation, of course, they are paying, and there's a huge amount of that borrowed money that they are paying as interest payments. Now over time, again, as they are seeing that the debt is rising, more lenders are getting even more worried, and they're saying, okay, fine, we'll lend you more money for your economy, but we'll increase the interest burden. So the debt is increasing, the interest payments are also increasing even further, and then it gets very difficult for them to step out of this loop, to take themselves out of this loop. Now that is definitely, there are certain measures that the US has to take. One is, of course, which is not very politically sort of savvy, I would say, which is increasing the taxes that it collects from people. Now this is never politically friendly for any government, for that matter. But that is for the government, in the US government, to figure out as to how to go about this process. But yeah, currently this is the particular situation.
Right. Bidisha, that brings us to the end of our episode today. Thank you so much for taking our questions from our dear members and always making the conversation so incisive. We'll be back again next week with another episode of Bidishanomics.